of this webinar, Mr. S.K. Sharma sir, Senior Consultant of AMFI and former DGM of Securities Exchange Board of India, respected Sabjar Ahmed sir, Coordinator of AMFI, respected HOD of Economics Department, Shapotgram College, Mrs. Smriti Rekha Borman, my esteemed colleagues, and all the respected participants. At the very outset, I, Dr. Jagomaya Paul, convener of today's webinar, as well as Assistant Professor, Department of Economics, Shapotgram College, on behalf of all the faculty members of Shapotgram College, I would like to convey my heartfelt gratitude to all of you for joining this webinar. So at the beginning, I would like to introduce our college. So Shapotgram College is a NAC accredited B+ college, and the college was established in 1972. The college is affiliated to Guwahati University and is registered under 2F and 12B of UGC Act 1956. This college is the first higher educational institution in this region, and the college has already passed its 50 glorious years, and in the last 5 decades, the college has been instrumental in making the youngsters of this region well educated, productive, more employable, and cope with the rest of the world. And today, a number of students of this college are pursuing their higher educations like masters, PhDs in different well-recognized universities all over the country. And most of the products of this college are occupying prestigious positions in various institutions of the country. So now let us move towards today's webinar topic. So as we know, the webinar topic of today is strategy for effectively managing personal finance for financial empowerment. So the objective of today's webinar is to help the audience gain better understanding of the investment opportunities, to create awareness about the need for making systematic savings for the future, to learn various investment avenues available in the market. So this is all about the webinar. Now I would like to invite our most respected principal sir to deliver his inaugural speech. So RP Singh sir, are you there?
Yes.
Yes,
are
sir.
you getting my voice?
Yes, sir.
Okay, because of some technical fault, my video is not working. I don't know what happened. But good evening, everyone. At the very outset, let me welcome our honorable guest, Suryakant Sharma, who is a senior consultant of All India Mutual Funds, Association of Mutual Funds in India. And he was also former DGM of SEBI, who is going to talk on a very important topic, which is related to us in our day-to-day life, as we all experience that there is some alarming situation in terms of economic recession and where to put in our money and what to do. We have no clue, in fact, because we are all not the student of economics. In any case, I welcome Dr. Sharma, first of all, in this seminar, and at the same time, I welcome Dr. Jogmaya Paul, who is the convener of this seminar, and also head of the department, Mrs. Smriti Rekha Burman, Miss Caroline Rengma, and Manisha Shingo. And at the same time, all the participants who are participating from different parts of India, in fact, online. And I hope that my colleagues are also there and some students are also there to take the benefit of this seminar. I hope that this seminar, which is a mind meeting, and it would definitely immensely help our associates, colleagues, and students to get benefit out of it. And I hope that the keynote speaker who is here to tell us about the subject, how this financial security or empowerment can be obtained. No other person can be as good as him because he has so many experience of SEBI and AMFI, and therefore I welcome everybody and extend my best wishes that this webinar becomes really successful. With these few words, I leave the dais to Dr. Jogmaya Paul. Thank you very much. And with this, I formally declare that this webinar, in fact, has been inaugurated. Thank you very much.
Thank you, RP Singh sir, for your most valuable inaugural speech. Now, I would like to invite Head of the Department of Economics, Shaporgam College, my beloved colleague, Smriti Rekha Borman, to present the welcome address. So, Smriti Rekha, are you there?
Yes, Jugomaya, I'm here. Good evening to all, respected principal sir, respected speaker, Mr. Suryakanta Sharma sir, my esteemed colleagues, my dear students, and all the participants present here. On behalf of the Department of Economics, Sapodgram College, I, Smriti Rekha Borman, Head of the Department, Sapodgram College, extend my warm welcome to all of you to this webinar on strategy for effectively managing personal finances for financial empowerment. First of all, I welcome our respected principal, Dr. RP Singh sir, to this webinar. I welcome our honorable speaker, Mr. Suryakanta Sharma sir. He has served in SEBI, Securities and Exchange Board of India, for more than 15 years. He has over 35 years of experience in banking, finance, and securities market. He is currently working in Association of Mutual Fund in India as senior consultant. We are very happy to have you, sir, as our resource person for today's webinar. Last but not the least, I welcome all the participants present here. The topic for today's webinar is very interesting and relevant for all of us. As we know that a financially empowered person can manage his spending in a better way, in an appropriate way. Financial empowerment gives us freedom, and it is one of the important and it is one of the most important source of our happiness. So we should have knowledge regarding managing our personal finances so that we can achieve our financial goals. Hope after attending this webinar, we all will be very clear about the topic. Thanks to all. Now I request Dr. Jugomaya Paul to continue the session. Jugomaya?
Thank you, Smriti Rekha Borman, for your wonderful presentation of welcome address. So now I'd like to present the profile of our speaker, Suryakant Sharma sir. So Mr. Suryakant Sharma is a commerce graduate and master's in law with specialization in corporate laws. Shri Sharma has over 35 years experience in banking and finance and securities market and has served in a leading financial institution. Thereafter, in Department of Financial Services, Ministry of Finance, Government of India, and finally in Securities Exchange Board of India. Shri Sharma joined Securities Exchange Board of India in 2003 and served there for more than 15 years in different departments of SEBI. Lastly, in addition to other assignments, he was DGM in charge of Office of Investor Awareness and Education in SEBI's Northern region for more than 5 years. Shri Sharma is also a member of working group of NCERT for developing vocational course on mutual funds for students of 11th and 12th classes. Shri Sharma is also mentor of a few NGOs working for financial literacy and investor awareness in the country. Under his supervision, more than 15,000 financial literacy and investor awareness programs were conducted across Northeast India, and he himself has addressed as a guest speaker in more than 600 IAPs. After superannuation from SEBI in 2019, he has joined Association of Mutual Funds in India and Apex Body of Mutual Funds in India as senior consultant North India. So this is all about profile of our speaker, Mr. Suryakant Sharma sir. Now this is the time to invite our resource person. But before inviting, I would like to request you to listen our speaker attentively so that you could be an effective and successful investor in near future. And please do not forget to leave your questions in the chat box below, and we will be always there to note down your questions, and your questions will be answered at the end of the session. At the end of the session, a feedback link will be shared, and after filling up and submitting the feedback form only, you could be able to get e-certificate. And regarding filling up of feedback form, your email ID should be correct. Otherwise, you cannot be able to get the certificate, and your name should be correct so that in your certificate, you should get correct name. So remember all these things. So let us now welcome the man who doesn't need any introduction and is known among all of us for his wisdom and his knowledge. And that is our honorable speaker, Mr. Suryakant Sharma sir. So sir, please begin with your most valuable and most awaiting speech on the webinar topic. Suryakant Sharma sir.
Thank you very much. Thank you very much. Am I audible to all of you?
Yeah, sir.
Thank you very much.
Yeah,
Respected Professor R.P. Singh, Principal of the college, respected Srimati Rekha Burman ma'am, Head of HOD, and of course, Dr. Jyoti Paul. If I remember,
sir.
Joguma, sir. If I remember, Joguma, sorry.
Yeah,
If I remember correctly, we had met earlier also in one of the programs.
Yeah,
I could remember your smiling face. So thank you very much for joining this, organizing this again in your college. And I am thankful to all the participants, your faculty members, your staff members, and participants for sparing their time on Saturday, which otherwise happens to be a holiday in most of the institutions. I don't know about your college, but in most of the institutions, Saturday happens to be a holiday here. So sparing time for this program, thank you very much. The topic today given by Srimati Rekha Burman for this seminar is strategy for effectively managing personal finance for financial empowerment. And Srimati Rekha ma'am, this is a very heavy topic, tough topic for me. I'm a student, you are all teachers, and I'm a student, for still I will try to justify whatever experience I have in my life. I will try to share my experience with all of you on the topic. There are 2-3 segments of the topic. First is, and the most important thing is, financial empowerment. And that can be attained only through personal finance management. So first we should understand what financial empowerment is. And Dr. Paul is well aware what financial empowerment is. Simply speaking, financial empowerment is nothing but I should have money when I need it. That is a simplest definition of financial empowerment. And we all should feel financially empowered because we will need money in our life, Smriti ma'am, not in one go, not in one time, but throughout our life. Rather, we will need huge money. Dr. Paul will need crores of rupees in her life when she will progressing in her career and her life in family and personal affairs as well. So we all need money. And Dr. Paul, you will agree with me, money is not God, but it is not less than God. पैसा भगवान नहीं है, भगवान से कम भी नहीं है. We all know it because we can lead a comfortable life or rather a minimum required life only through money. That is why the importance of money in our life. And Dr. Smriti, money gives us two things basically. The first and important thing money gives us prosperity, that is financial empowerment, you can define in a different way. And the other thing also money gives us financial security. Money also gives us security. But Dr. Paul, you will remember that I had mentioned last time as well that money gives us security only when we have plenty of money. And I had specifically mentioned that one day Dr. Paul will have 100 crore in her bank account one day. Then she will feel secure. No, Baba, no problem. Now I have got 100 crore in my bank account. I feel secure. Dr. Smriti is smiling when I'm mentioning about the 100 crore because we all know that at least through service, Manisha ma'am, we will not be having 100 crore in our bank account. That is a fact of our life. So how we can develop security for ourselves and for our family, that is the most important question before us. And I personally feel, Dr. Manisha, that first we should think about the security, then we should think about the prosperity. Because security comes first in our mind. How we can do it? Yes, my dear participants, and particularly young participants, even your student, they should understand that every person can develop security in her or his life, not only for herself or himself, but also for the family by doing Dr. Paul, these three things at the beginning of your career itself. So please note it down. I am telling to your student specifically, please note it down. These three things you will have to do, you will have to complete in the first year when you start earning. Of course, Dr. Paul, Dr. Smriti, Dr. Manisha is already earning. So they should also think whether they have done these three things for security of themselves and for family as well. And Dr. Manisha, the most important thing relating to security is taking a life insurance cover. We must take adequate life insurance cover at the beginning of our career itself. Normally, we are casual, Dr. Manisha. You might have taken some cover, life insurance cover. I don't know whether you have taken it or not. But normally, we do take. Dr. Paul must have taken that cover. But normally, we take token life insurance cover. A life insurance cover of Professor Cyril, only 5 lakh, 10 lakhs. But my dear participants, I want to tell you that life insurance cover has to be adequate. This is the second requirement when we take life insurance cover. And why we take life insurance cover, Dr. Manisha? The purpose is very simple. Life is pretty uncertain. I can see Dr. Paul, I can see Dr. Manisha, I can see Dr. Smriti, Professor Cyril, and all participants. We are all happy. We will continue to be happy for the next 100 years. But are we sure what will happen tomorrow, Manisha ma'am? Can you say with certainty what will happen tomorrow? Nobody is certain because life is pretty uncertain. Life is unpredictable. Things can go on very smoothly for next 50 years, but anything can happen tomorrow even. That is why this uncertainty in life gives us a fear. And more so, Dr. Manisha, when I am the single earner in the family. What is the fear? that everything is going smoothly in my family. I am managing my family more so when I am the single earner in my family. Everything is going well. But if something happens tomorrow and I am not available to my family, how they will survive? It is a very, very $1 million question. Because everything is going on smoothly on my salary, on my income. But if I am not there to support my family tomorrow because of death, what would happen to my family? This fear takes us, or rather lead us to take life insurance cover, that in case something happens to me and I'm not available to my family tomorrow or in future, at least my family should not suffer financially. Of course, emotional problem, Dr. Smriti, will be there. Social problems will be there. But the most important problem will be of finance. How my family will get monthly ration, how my kids get their education in my absence. So these things, just to take care of that thing, we take life insurance cover. And here the importance of life insurance cover. And we normally we do take, Professor Cyril must have taken life insurance cover, sir. I had also taken when we were young, but that was a different time altogether, sir. We had taken life insurance cover of 1 lakh, 2 lakh, 5 lakhs, or max 10 lakhs. But now that life insurance cover, if we look at that, is grossly inadequate, because that will not happen any contingency or mishappening in my life, or for my family. That is why I keep emphasizing that taking life insurance cover is a must for every earning person, more so when he or she is the sole earner in the family. But it has to be adequate, Professor Cyril. And adequate simply means that your family should get a reasonable, or rather good money in case something happens to me, so that they can survive. Kids can continue to get education. There will be no problem. There should not be any problem with regard to monthly expenses and all other liabilities which we normally think about in our life. That is why first thing, take life insurance cover. And second, you take adequate life insurance cover, Professor Smriti. And the definition of adequate life insurance cover simply means your life insurance cover, Smriti ma'am, should be not less than 20 times of your annual income. Suppose your annual income, Dr. Smriti, is 20 lakhs, then ideally speaking, you should take life insurance cover of not less than 2 crore of rupees. Because only that much of money will give some buffer to the family in case I am not available to them tomorrow because of that. That is why we should take life insurance cover, and it has to be adequate. We should not take life insurance. And in my times, and Professor Serel will agree with me, in my time, Manisha ma'am, we had taken life insurance cover, but that was hardly 1 lakh, 2 lakh, 5 lakhs. But now the time has changed. You have to take life insurance cover, and it has to be adequate. And here one more thing, early you take, lesser will be the premium, because the life insurance cover premium is directly related to your age. So please don't keep deferring the decision of taking life insurance cover. Take it. It might happen that you take it reasonable life insurance cover today, Dr. Paul, and down the line after 5 or 10 years, you can increase it. You can step it up. But please do take life insurance cover here, and reasonable life insurance cover. This is the first request I want to make all the participants, and even your students should understand, when they start earning in the first year itself, they should take adequate life insurance cover. And nowadays, a very good insurance product is available in the market, Smriti ma'am, that is called term insurance, TERM, term insurance. That is genuinely and real insurance cover. Because normally earlier, whatever insurance products were available for us, with us, were saving linked insurance cover. But now the thing have changed, and now even we have become mature, and we should distinguish between insurance and investment. we should not link insurance with the investment. Keep it separate. Keep it separate. Take life insurance cover, pure life insurance cover, through term insurance, and invest your money in a different manner for melting money or rather making money out of your money. So don't mix insurance and investment. Keep it separate. Take adequate life insurance cover through term insurance, and it should be taken at the early stage of life. Second thing I want to tell all of you, please do take adequate health insurance cover in your life. I don't know, Dr. Smriti, what your college is giving your medical facility to you. Normally, employer do give some medical facilities, but they are grossly inadequate. More so when because of some emergency or some serious illness in our body or unfortunate accident, huge money is required because we will be forced to go to the private hospital because Dr. Professor Sril will agree with me. Even after 75 years of independence, our governmental health system is not up to mark. So we will be forced to go to the private hospital, but there the problem is different, Dr. Smriti. Their charges are exorbitant. If a person remain in a private hospital for 10, 15 days, they may raise a bill of not less than 10, 12 lakhs from where that money will come. That is why I am requesting all of you, please do think of taking some independent health insurance cover. Even when your employer is giving some health allowance or some medical facilities. Because I know Dr. Paul will not be remaining in this college for life. She must be moving to some other colleges, some career progression. That is very natural nowadays. So you should take independent health insurance cover, not only for yourself, but also for your family. And for that, nowadays, Dr. Smriti, a very good unique health insurance product is available in the market, which is called Floater Health Insurance, FLOATER, Floater Health Insurance. It is also called Umbrella Health Insurance cover. And the beauty of this health insurance cover is that when you take this health insurance cover, you have got leverage to include not only your name, but also the name of your spouse, your kids, your parents even. So in one singular health insurance cover, all members of the family are covered. And in case of any eventuality of or mishappening, or some serious disease being discovered in our body, or or an accident, we can go to the best hospital nearby, get the best treatment, come home recovered without paying a single penny. All your hospital bill will be directly paid by the insurance company to the hospital, and you will not be paying a single penny. It is also called cashless treatment. So you will not be required there any money to pay to the hospital. Or if you have taken adequate health insurance cover, all hospital will be settled directly by the insurance company to the hospital, and you will not be required to pay. That is why the importance of taking adequate health insurance cover. And here again, early you take, lesser will be the premium. And for both the premium of life insurance cover and health insurance cover, Dr. Smriti, income tax deduction is also allowed to a certain extent. So get those benefits also, but don't take life insurance cover or health insurance cover only for the sake of availing the exemption under Income Tax Act, because the purpose of taking life insurance cover and health insurance cover is much bigger than all these things. So please do think that you should take adequate life insurance cover at the beginning of your career, apart from life insurance cover. And both in things, Dr. Smriti, will give you security only. Don't think it as an investment. Keep it, I again should not repeat, keep it investment separate and insurance separate. And the third thing I want to request all of you, and Professor Saidal will agree with me, we have all passed through a very tough time very recently, due to pandemic corona. Corona is still not gone, Dr. Paul. It is still around us. The newer and newer viruses are coming every day. But even we presume that Corona is gone, has gone. Corona has taught us a very important lesson, Dr. Smriti, and that is every family must always have an emergency fund of around 5 lakhs with them.
Sir, sorry to
Why?
disturb you. Sir,
Yeah,
sorry to disturb you, sir.
yeah,
Sir, actually, I am just pursuing my PhD degree only.
oh, no
Till
problem.
now, till now, I am not a doctor. Okay, sir.
You are going to be doctor, don't take it otherwise.
Yes, yes.
Yeah.
Sorry to
When
disturb
you
you, sir.
no, when you will have your PhD degree, we will come to your college physically on your convocation.
Thank you, sir.
All the best, all the best, and you will be getting degree
Thank you,
very
sir.
soon.
Thank you.
So I am giving you in advance congratulations for getting your PhD degree. Take it that way. So third thing I want to prepare to tell all of you, please do develop an emergency fund of around 5 lakhs. That emergency fund, Smriti ma'am, again I will repeat Dr. Smriti only. Don't take it otherwise. Because in advance I am giving you congratulations. So emergency fund is required in the sense that in case something happens like Corona again, at least we should not be having some financial problem because Manisha ma'am, when Corona came and that was all of a sudden, you are very lucky. I don't know, you are might be a government college, but you are very lucky, continue to get salary. But Dr. Jogmaya Paul ma'am, lakhs of people had lost their job. We are all aware. Lakhs of people have lost their business, no business at all for months together, no profession for months together. The people have suffered very, have passed through a very tough time in those days. And these tough times may recur again. That possibility is there. That is why I keep telling in my session to participants, please do develop an emergency fund of around 5 lakhs. This emergency fund will take care of contingency if something happens in our life, all of a sudden, or job, we lose our job, or something happens like that. So we can continue to take care of our family expenses minimum for 1 year. That is why we should develop an emergency fund of around 5 lakhs. And I'm not saying that 5 lakh is a small amount, Smriti ma'am. It is a big amount. But we can develop it over a period of time, maybe 3 years, maybe 4 years. But once we have 5 lakhs as an emergency fund, we have to make it a promise that this is an emergency fund and will be used only in case of emergency in our family. Otherwise, we will not touch it. Normally, Smriti ma'am, when you have 5 lakh rupees with you as emergency fund, your family will keep pressurizing you, go on vacation, have some celebration. That is very natural. But we should be very clear, no, we will not use it for any other purpose. This is an emergency fund and will be used only in case of emergency. And I am not saying that you keep this emergency fund at your home in a currency form, in a bag or a box. Better you go for a good FD fixed deposit in a good bank so that you will reasonably earn something on it as well, and the money will be at your command all the time. So 3 things I again repeat, Smriti ma'am: adequate life insurance cover for every individual, adequate health insurance cover for the whole family, and third one is an emergency fund of around 5 lakh at the disposal of family all the time. And these 3 things, Professor Cyril knows it very well, will give us only security. It is not related to your prosperity. Please mind it. But I again repeat, security is more important than prosperity. Prosperity comes second, security comes first. So please do develop these 3 things in your life at the start of your career. And if you have not developed that, Smriti or Jogmaya ma'am or Manisha ma'am, please do think of doing these 3 things or developing these 3 things in your life as early as you can. Now, definitely, we start discussing about the prosperity as well. Otherwise, Paul ma'am will say, sir, you are focusing only on security, nothing about investment, nothing about prosperity, nothing about financial empowerment. The topic we had given you is financial empowerment, and you are still continuing with the security only. No problem, ma'am. Now we are coming to prosperity as well. As far as prosperity is concerned, and as far as the financial empowerment is concerned, Smriti ma'am, that will come only through wealth creation. Prosperity is possible only through wealth creation. And you will agree with me, what is wealth creation? It simply means that my money should also earn money for me. That is wealth creation. And how we get money, Manisha ma'am? The source of money for all of us, those who are service class persons, the main source of money is your salary. I don't know whether Dr. Jogmaya Paul has got other source, but the main source otherwise normally for all of us is salary only. And what we do with the salary, Smriti ma'am, majority of our salary goes into taking care of our monthly and regular expenses. Majority of our salary goes into that. But we Indians have a unique DNA, unique blood. And Manisha ma'am knows it very well. And what is that? Every Indian, and for that matter, every Indian family tries to take away some money out of their regular income, which they don't spend. Otherwise, compulsions are there, aspirations are there, needs are there. But still, despite all these things, every Indian family try to take away some money. Of course, some can take away good money, some hardly many, some very small money, but we all try. And Smriti ma'am, the money which we don't spend out of our regular income, what we call it? It is called savings. It is called savings. The money which we don't spend out of our regular income, it is called saving. And we all save it. Dr. Jogmaya Paul is very sincere and serious about saving as much as she can. And we all. So we always try to save some money out of our income. Of course, nowadays, Smriti ma'am, it is difficult because of inflation and all these things. But still we try. Still we try to save as much as we can. So we are all savers. And this is the unique thing with Indians, Paul ma'am. You must be knowing this is a very big thing. The 2008 downturn in economy across the globe had proved it that Indians are very solid, very strong, only because of their saving habit. We were strong, we could withstand the problem of 2008 economic meltdown in 2008, only because the saving is inbuilt. We save it very sincerely. So we are all savers. We save the money. And why we save, Smriti ma'am, have you ever thought why we save the money? Why we don't enjoy with the money which we earn? What is the reason we save the money? What is the need of that? Manisha ma'am, because we are very clear that for future or requirement of money is huge. That will not be met by the money which we will earn in future. That is why we save today. That is why we sacrifice a lot of things today for future. That is why we sacrifice a lot of things today for our better tomorrow. So we save it. So saving is in our habit, saving is in our blood. But two things lack here. Look, ma'am, I don't know what about you, but our normally speaking middle class, salary class person, three things lacks with regard to saving. And one of the most important thing is that we do save, we are savers. But unfortunately, Dr. Smriti, we are casual about savings. Casual simply means this month I might have saved 10,000. Second month I might have saved 12,000. Third month I might have 8,000. And fourth month may even be zero. Of course, reasons might be there. I am not So that there will not be region. Region will be there. But on the contrary, what I am emphasizing here, please identify an amount of saving, Dr. Jogmaya, which you can comfortably save every month. And I am leaving it to you. Normally, Smriti ma'am, people will keep advising you, save 20%, save 30%, save 40% of your income. That is not my cup of tea. What I am saying here is, do decide what you want to save, what you can comfortably. Suppose Manisha ma'am says that her salary is 50,000 and her monthly expenses are around 40,000. So what she indirectly saying is that she can save 10,000 a month. Then Manisha ma'am, my request is very simple but emphatic. Please do save this 10,000 every month without fail. That commitment and that discipline has to be developed. There is no other shortcut. And it can be developed. It's a matter of time only, Professor Saidil, because it is a matter of developing a habit. Once this thing comes in our habit with commitment, we will start saving that amount without fail. So please do identify the first thing about saving. I want to request all our participants, even students, they should understand. Please do save the amount, regular amount, whatever you have decided regularly without fail every month. And second thing is, please keep increasing, Dr. Smriti, please keep increasing your savings every year minimum by 10% because you will get increment, you will get increase in your salary, some allowances will keep coming in your career, in between you will also be getting promotion. Because of all these things, your income will keep increasing. With the increase in income, you must increase your savings also. And it should ideally be 10% every year. Suppose this year, Dr. Smriti, you are saving 10,000 a month. Next year, it should be 11,000 a month. And third year, it should be 12,100. Of course, looks tough, looks difficult. I know it is difficult, but Professor Saidil will agree with me. It is not impossible. It is possible, Manisha ma'am. Only thing required is commitment. Only thing required is discipline. Only thing required is your developing a habit that come what may. I will save this amount. I will keep increasing my saving every year. And this can be done. It is possible, my dear participant. Looks tough. I know it is difficult. But for bigger things, Manisha ma'am, we have to be tough. We have to go for the tougher things. Because we have to enjoy our life with the help of money which we will be needing in our life in future. So saving is important, regular saving is important, increasing saving is important every year. Now the second question arises, and which is very normal and natural, is what we do with the savings, Smriti ma'am? What do we do with the savings which we are making every month? Dr. Jogmaya Paul ma'am has committed with me, I will start saving a particular amount every month now. But what you will do, Dr. Paul, with regard to your savings? Yes, there are two options. One option, Dr. Smriti, is that whatever I am saving, what I am foolishly doing, which nobody should do, I am saving a particular amount every month. But what foolishly I am doing, I am taking out that amount from my salary in my bank account where I get normally my salary, count that money, feel happy, and go to home and keep that money at home in a box every month. And religiously, Manisha ma'am, I'm doing it. I am saving and keeping my money of saving at home every month, or just leaving that amount in my bank account. My dear participant, Dr. Paul is smiling. She is well aware of this thing. But because we should never keep our savings at home in a currency form or leave that amount in our SB account where we get salary. Because Professor Saidil is well aware, it is a gross injustice to ourselves, to our family, and to our country as a whole. Please stop it if anybody is doing that. then naturally what we should do then? This question will definitely come up. My answer is very simple. Please put your savings, Dr. Manisha, into number one, acquisition of some assets, value of which will increase in future, and put your savings into some financial instrument which will give you regular and periodical return in future. And putting your savings into some assets or in some financial instrument, Manisha ma'am, it is called investment. It is called investment. So we should not only be saver, but we should also be investor. Saving, Professor Cyril will agree with me, is a first step, and investment is a second step. So we should not only save, but we should also invest. Why? Answer is very simple, Manisha ma'am. Only investment will make your money. Only investment will make your money to earn money. Of course, saving is the first step, but only saving is not going to make you prosper. Please understand it very carefully. Saving will pave the way for your investment. That is not why saving is important. But then we must invest our saving. This is second and most equally important thing. So my dear participant, you should not only have to be saver, but we should also be investor for wealth creation. Because wealth can be created only through investment. Please mind it. That is why we have to be investor. And naturally, Professor Farrell, you will agree with me, those who are earning and saving something are natural investor as well. Because they are putting their money somewhere in one or other product. We are all putting our savings into one or the other product. So we are all investors. We are all investors. Those who are even students, they should understand that when they will start earning and start saving, they will definitely put their saving into one or other product. But unfortunately, Manisha ma'am, I don't know whether you will agree with me or not. Unfortunately, most of the middle class, salary class person, despite saving and investment, they just remain money accumulators. They don't become wealth creators. And Dr. Paul, you have to be wealth creator. You should not be money accumulator. There are two different things I am mentioning here. One is money accumulation and other is wealth creation. And unfortunately, Manisha ma'am, most of us are sheer money accumulators. And top of it, we don't accept it. Manisha ma'am will never accept that she money accumulator. She will say, no, I am not. Dr. Paul might be. Or my other colleagues might be. I am not. You see the feeling we all have. Because what we feel, whatever we are doing is okay. But please open your mind now. Things are changing, Manisha ma'am. We should see that we should not be money accumulator and we should be wealth creator because Manisha ma'am, prosperity will come only through wealth creation, not through money accumulation. This should be very clear to all of us. So what is the difference between money accumulation and wealth creation? Manisha ma'am, I just want to give you a simple example. Dr. Paul has put her video off. So I take the example of now she has come again. Thank you very much.
No, sir, I'm here, sir. Listening you, sir.
Thank you very much. No, I want to take your name in an example. That's why I was.
Okay, sir, you can take, sir. It will be my pleasure, sir.
Just for example, just to make you understand what is the difference between money accumulation and wealth creation, I take a very simple example of bank fixed deposit, Manisha ma'am. Why I am taking this example? Because even students are aware about the bank FD. Of course, Professor Cyril and Manisha ma'am must have gone for big FD in the bank. But even students understand what bank FD is. That is why I am taking a very simple example. Suppose Dr. Paul has got 1 lakh rupees with her. Of course, she has got much more than that. But just for example's sake, she has got 1 lakh rupees, Dr. Manisha, and she goes for a 1 year bank FD with a good bank. 1 year bank FD, 1 year bank FD. And nowadays the rate of interest, Dr. Paul, you will agree, is around 5.5% or take it 6%. So she goes for a 1 year bank FD at the rate of 6%, Manisha ma'am. After 1 year, myself and Manisha ma'am meet her and just ask her, Dr. Paul, what happened to her FD which you had done last year? Manisha ma'am is smiling, she's happy. Her answer will be that she has earned 6,000 rupees as bank interest income. And bank has given back her 1 lakh rupees. Am I right, Manisha ma'am? This is a normal thing. She will answer because 1 year FD will earn 6,000 rupees as bank interest at the rate of 6%. And she will get back her 1 lakh rupees after 1 year. And she's happy. Then I ask her, Dr. Paul, are you right? Dr. Paul otherwise is smiling, but she might get angry. She said, yes, I'm absolutely right. Where I am wrong, you can see my passbook. I have got a bank interest credit of 6,000 rupees and have got my money back of 1 lakh rupees, and she's right. Dr. Paul, you are right, but you are not. You are right. Definitely you got 6,000 rupees, but Smriti ma'am, she's not right. Why she's not right? Because she simply ignored two very important factors while analyzing the return on her investment, and FD is also an investment. And what these two factors are, Smriti ma'am? The first and most important factor is inflation, mehengai. We talk about inflation, Professor Sainil, day in, day out. Every day we talk about inflation. Even in your staff room, faculty room, there are hot discussion nowadays in inflation. The prices are increasing, this and that. Petrol prices have increased, grocery items prices have everything. And this is a hot topic nowadays. So what is inflation? Smriti ma'am, can you tell me what is inflation? Inflation simply means increase in the prices of goods, item or services over a period of time. Am I right, Manisha ma'am? Simply speaking, inflation is nothing but increase in the prices of increase in the prices of goods, item and services. Suppose last year when Dr. Paul was going for bank FD, had she not gone for bank FD and might have purchased some items from 1 lakh rupees. Smriti ma'am, can you tell me, will she be able to get the same item, same services after 1 year at 1 lakh rupees? Will it be possible, Dr. Paul? It will not be possible. Because of the simple reason that because of inflation, prices of those items have increased. And suppose the inflation rate during this 1 year when she had FD, the inflation rate had been 5%. What does it mean, Dr. Smriti? It simply means that last year, whatever she could have purchased for 1 lakh rupees, after 1 year for the same item, same goods and same services, she will need to pay not 1 lakh rupees, but 1 lakh 5,000 rupees.
5,000 extra, sir. Yes.
5,000 extra because of inflation. Now you
Yes,
see, now you see she was very happy when she got 6,000. But in reality, out of 6,000, 5,000 has been eaten by the inflation. This is a fact of our life, which we should have normally we don't appreciate. We are happy whatever we get. But in reality, inflation eats majority of our return on our investment. So please do mind that inflation is a very, very important factor while analyzing return on our investment.
Yes, sir.
But still, Dr. Paul is happy. Okay, let 5,000 go. Let 5,000 be eaten by the inflation, but she is still happy. She said, no, sir, no problem. I still have 1,000 rupees out of 6,000. No, ma'am. There is another factor which we normally ignore. And that is that, Dr. Smriti, most of the return or income on investment, Government of India takes income tax or capital gain. Most of them. And with regard to FD, rules are very clear. You might not be aware. Whatever you earn as interest on FD, Dr. Paul, that will be your income and will be included in your total income of the year. So the 6th year which you have earned will be included in your income for the whole year, and you will have to pay income tax as per your income tax slab. And suppose Dr. Smriti and Dr. Paul is in 20% bracket of income tax, then she will need to pay 20% income tax on 6,000, which comes to 1,200. And now she can't avoid. In my time, and Professor Sarel will agree with me, in our times, we used to say, let it be. Who from income tax department will come to collect that money? But Manisha ma'am, that now time has changed. Because of technology, all such information is automatically available with the income tax department. The moment Dr. Paul got 6,000 rupees in bank interest income tax department is well aware that she has got 6,000 rupees as bank interest income, and now she can't avoid it paying tax on it. So suppose 6,000, 20% income tax, Smriti ma'am, it is 1,200 rupees on 6,000. Now you see the proposition. Dr. Paul was very happy, smiling when she said that she got 6,000 rupees as bank interest income. But in reality, out of 6,000, 5,000 has been eaten by the inflation, and 1,200 she has to pay as income tax. Did she get anything, Dr. Smriti? No. Rather, 200 rupees has gone out of her pocket. Nothing. She got nothing. In reality, notionally she was very happy. She got 6,000, but in reality she got nothing. That is why we have to see very clearly and distinctly that we must get some real return on our investments. And what is that? What is the formula of real return, Smriti ma'am? Real return equal to notional return minus inflation minus tax liability, if any. So,
Actually, sir, we have to we have to use the discounting rate, na? From
very right.
future value to present value, we
Very
have to
right.
discount the value.
Definitely, you are right. So 6,000 Dr. Paul was your notional income. It was not your real income. To arrive at real return, you have to discount what Smriti ma'am just mentioned, inflation and tax liability, if any. After that, if something remains, that is your real return. Otherwise, you are sheer money accumulator. You are simply feel yourself happy, whatever you earn it, but in reality, you got nothing. That is why I keep emphasizing in my session, Professor Cyril sir, that young people should be very, very particular and emphatic that that they should earn some real return, Dr. Aditya, on their investment. And they should never be satisfied. They should never be satisfied with the notional return. They should always keep in mind, and they should work very hard that they earn some real return on their investment. Now, what is the reason that most of us don't get real return? What is the reason, Smriti ma'am? There is a reason, and the reason lies not somewhere outside, Smriti ma'am. The reason lies in our minds. Most of the middle class, salary class person, Manisha ma'am, are very clear. They are very clear. We don't want any risk. Arey Baba, we don't want any risk at all. We want safe investment. Normally people say, I said, tell us something about safe investment. We don't want any risk in our investment. So our mindset is like that we will never go for any risk. We want safe investment. This is normal thinking of middle class, salary class person. And that is why when I reach at this stage, Manisha ma'am, one or two poser come in the chat box, but tell us something about safe investment. Because we are risk averse, we don't want to take any risk. But my answer to that question is very blunt. I don't know whether Smriti ma'am will agree with me or not. My dear participants, in investment, risk is there, whether you accept it or not. In most of the investment, Professor Cyril, invest in most of the investment. Like life is also, we have got a lot of risk. So in investment as well, risk is there. Of course, degree of risk will vary from product to product. In some product, the risk will be very higher, Dr. Paul. In some product, it might be moderate. In some investment, it might be minimum. But except some governmental small saving scheme, which we will discuss afterwards, risk is there. So please do, of course, Professor Cyril will not accept it because of age. But those who are young, Manisha ma'am, Dr. Paul, Smriti ma'am, you should accept that in investment risk is there. Because unless and until we accept, there cannot be any way of handling and managing risk. We can manage our risk. Definitely we will. But first we should accept that risk is there. So in investment, risk is there. Please do accept it. And once you accept, then naturally the second question which will come in your mind, Smriti ma'am, is how I should minimize my risk. That is very natural. Everybody would like to minimize their risk. Everybody would like to manage their risk. Yes, we can, my dear participants. Dr. Paul is very much confident, and with her confidence, I can also say we can manage our risk. We can minimize our risk. But again, Dr. Paul, risk will never be zero. Some degree of risk will always be there, except some governmental scheme, which I should not repeat again and again. In most of the investment, risk is there, but we can manage it, we can minimize it. How? Smriti ma'am, I am sharing a very simple two-word formula. Manisha ma'am will laugh at me. Sir, you are talking very simple things you are talking to us. And we are professors, we are intellectuals, and you are giving some very small things. But Manisha ma'am, I am of the firm opinion that these simple things might change your life, or at least your thinking to be a smart and successful investor. So we can manage your risk, we can minimize your risk, my dear participant, by practicing a very simple two-word formula. Very simple two-word formula. And I know Dr. Paul will laugh at me, sir, this formula is very simple. Only two words you have used, how they are going to change your life. Yes, yes, my dear participant, I am giving confidence not only to Dr. Paul, but all participants. This formula will change your thinking with regard to investment risk. And formula is very simple, Dr. Smriti. Only two-word formula. First, I will speak in English and then in Hindi also I will try to speak it. Think, understand, and invest. Only two words I have used here. Think, understand, and invest. So, सोच कर, समझ कर, निवेश कर. सोच कर, समझ कर, निवेश कर. Smriti ma'am, I have used two words. First is think. What we have to think, Professor Cyril? First thing we have to think about ourselves, Dr. Manisha, is what is my risk appetite? What is my risk appetite? And in Smriti ma'am, every individual has got different risk appetite. You have got different one. Manisha ma'am has got different one. Dr. Paul has got different one. Professor Cyril has got different. Everybody has got. Mr. Giridhar has got different one. Why? Because our age is different, our income is different, our social background is different, our standard of living is different, our family obligations are, everything is different. So we should take our investment decision strictly as per our risk appetite. But unfortunately, Manisha ma'am, I don't know whether you have done that mistake, but most of us have done this mistake. And what is that? Most of our investment decisions have been on the strength of investment being made by others. Your colleague, your friend, your relations, somebody, if Manisha ma'am is making some investment and Smriti ma'am sees that she is making some, and she knows Manisha ma'am is a very smart investor, that what Manish, Smriti ma'am will do. I should also make investment in that product. That is a blender we all do. But I will request all of you, never follow others with regard to your investment decision, because the risk appetite of Manisha ma'am is different and risk appetite of Smriti ma'am is different. So you take your investment decision strictly as per your risk appetite. Never follow others while taking your investment. See, the first thing I want to tell you. And even Smriti ma'am, your risk appetite will keep changing with the age. When you are young, which you are, you can take high risk. But when you will reach the age of myself and Professor Cyril, your risk appetite will be literally zero. Literally zero. Because now we can't take risk. But you can take risk, and rather you should take risk. Manisha ma'am, I keep encouraging young people that they should take risk. And of course, Dr. Paul will has promised me to take more risk in her investment in the coming years till she reaches 55, 60. Then, of course, the reverse it will be happening. Myself and Professor Cyril now will not can't take a risk, but you can. So I keep encouraging young people like Smriti ma'am. You should take a risk, but your risk should be as per your risk appetite, and your risk should be calculated. Smriti ma'am, it should not be blind risk. It should be calculated. And calculated simply means as per your risk appetite. So please do take your investment decision strictly as per your risk appetite, and which broadly depends upon your age and your family obligation and income and other factors. Second thing we have to think about ourselves is time horizon of investment, and that is equally important, Smriti ma'am. We hardly give any credence when we make investment decision. Suppose Manisha ma'am has got 5 lakhs rupees, she will put without looking at the investment product when they will start giving you return and when they will return your money. Because Manisha ma'am, time horizon of investment is equally important. Why? Because we need money not in one go in our life, Dr. Paul. We will need money at many intervals in our life for our major milestones in our life. That is why time horizon of investment is equally important. And to make you understand about the importance of time horizon, again I will take the name of Smriti ma'am. Just giving an example, taking her name in this example. Next Sunday is Smriti ma'am, and I'm not limiting myself to Smriti ma'am only. I'm requesting all the participants. Next Sunday, please sit with your family member. Request your family members to be with you. Take one paper and pen with you. Make 3 columns on the paper. In the first column, after discussing with your family members, Mr. Netrapal Singh, make a list of the major milestones in your life. What are the major things which will be happening in your life? And normally, Smriti ma'am, what are the major milestones in your life? Normally speaking, the first one is marriage. Marriage is the first milestone in your life, normally. After that, birth of the children, naturally celebration, we will need good money. Then afterwards, admission of the children in a good public school, again we will need good money. Then every family will need their own house. Every family aspires to have their own house. For that, we will need huge money. Then, if you have not got so far 4-wheeler, definitely we would like to have minimum 4-wheeler in our, for our family. It is the minimum thing everybody aspires nowadays. After that, one more thing which is common nowadays, which was not in my time for Professor Cyril's life, but now it is very common, and Dr. Paul will agree with me. That is going on vacation. Dr. Paul is already planning going on vacation, international vacation, national vacation, every 2 years, every 3 years. That is very common nowadays, very common. With every family, rather if you don't go out, and Manisha ma'am, your family will force you to go for it. Why you are in Assam only? Go to Rajasthan, go to Maharashtra, go to Tamil Nadu. We have a huge country in the location. And why within India also go to Switzerland, go to, that is very natural. Every family will like to go. So vacation has also become a very important milestone nowadays, which was not at least in my times. After that, after certain years, one of the most important milestones will be happening in your life, Manisha ma'am. That is higher education and professional education of children. That is one of the most, every parent will like their children to get the best higher education and professional education. After that, once their education is over, what will be the next, Smriti ma'am? Marriage of the children. Naturally, once their education is over, you will think of their marriage. And one and last important thing is living retirement life. That is also very important. I don't know whether you have pension. I don't know whether your college is a government college or a private college. But even if it is a government college, those who have joined after 2004 have no pension. So living retirement life, Dr. Paul, is a big thing nowadays. Earlier, people were very lucky. I am very lucky, honestly. I am getting good pension from the government. So that way, but those who are young, now normal pension will not be there. Of course, government has now introduced NPS. That is a different story, but NPS is not a pension as such. It is basically contributory pension. You earn your pension, and that again there are a lot of shortcomings in that scheme is there. So living after retirement is also a very big thing, because the most important minus point happens after retirement, Dr. Paul. I will not be getting salary in my bank account, which I am getting today every month. That is the only minus point, Manisha ma'am, will be there. So how I will live my retirement life? And one new development is happening in our country, Manisha ma'am. The average age of Indian has increased like anything. When we got independence, our average Indian age of the Indian, Smriti ma'am, was 37 years only. Now it has increased to 70 years. It means normally after retirement, you will be living not less than 10, 12, 25 years. And no income, no regular income. How you will survive? So normally what people do now and will have to do now is to accumulate huge money for their retirement life, and then they get a return on it and live your life. So in the first column, Smriti ma'am, you just jot down that the major milestones in your life, and if I have missed something which we just discussed, I am giving you liberty to add that milestone also. In the second column, against each milestone, start putting the period when it will be happening. Again, idea only, I mean, an estimate only. Precisely, of course, you can't do anything at this stage, but just have an idea. Suppose somebody said that you are not married and he or she like to be married after 2 years, then put it 2 years away marriage. Likewise, 2 years, 3 years, 5 years, 10 years, 15 years, 20 years, 30. Start putting the years when that milestone is likely to happen in your life. And the third and most important thing, Smriti ma'am, is now start putting the money which you will need for every milestone. Suppose you say that somebody like to be married after 2 years, he or she not married yet. Other marriage expenses will be taken care of by their parent, but Smriti ma'am, at least honeymoon package will have to be purchased by them. So that is minimum thing. That suppose they say that 5 lakh honeymoon package will come, but it will not be 5 lakhs today. Smriti ma'am, today you are thinking about 5 lakh honeymoon package. But after 2 years, when this actually goes for the honeymoon, it will not be 5 lakhs. Because of inflation, it might be 5.50 lakhs or even more. So start putting the money against each milestone in taking inflation as a factor, including inflation as a factor as well. Two important milestone I want to discuss with all of you. That is higher education and professional education of children. Smriti ma'am, today a good MBA degree from a reputed institution costs not less than 50 to 20 lakhs. 2-year MBA degree. That is today. But Manisha ma'am, when your children will be going for higher education after 20-25 years, have you ever imagined, Dr. Paul, what will be the cost of an MBA degree for your children? Today it is around 20 lakhs, but after 25 years, Smriti ma'am, it will be not less than 2 crore rupees because of inflation. And perchance, if you have got 2 children, then 4 crore rupees only for the higher education and professional education of your children. It might be, you might be panicky. You might have, I'm not scaring you, but I want you to be scared because this is a fact of life. So, and one more thing I want to tell you about retirement. So for today, Smriti ma'am, you say that your monthly expenses are around 30,000. When your age is around, of course, I am taking risk of mentioning your age there. But just for example, say you say it 30 years today. So at the age of 30, your monthly expenses of around 30,000 per month. Smriti ma'am, when you will retire after 30 years at the age of 60, have you ever imagined what will be the requirement of money for your monthly expenses? Your monthly expenses requirement is around 30,000 today. It will be not less than 2 lakh rupees per month when you attain the age of 60. So 2 lakh per month multiplied by 12 means almost 25 lakhs per year at the age of 60, at the first year of your retirement. From where that money will come, because salary will not be coming in your bank account, no credit of salary. So normally what we do, we accumulate money, deposit that money for some investment and get regular return on it. And that return has to be sufficed to take care of your retirement expenses. So you should develop a corpus of minimum amount which will earn you 25 lakhs per year. And how it should be corpus? Smriti ma'am, a simple formula I am sharing with you. Your retirement corpus should be minimum 20 times of your annual expenses. Your annual expenses at the age of 60 will be 25 lakhs multiplied by 20. What it becomes? 5 crore rupees. So you will need 5 crore rupees only for your retirement life. Now I want you to be scary. Make the total of the last column. And you will be surprised, Dr. Smriti, that those who are around 30 today will need not less than 10 to 12 crore rupees for their milestone only. From where it will come? From where it will come? I know Dr. Paul is very lucky, and she definitely is. She is going to KBC Amitabh Bachchan show and going to win 7.5 crore rupees.
No, sir.
Definitely you will. But what about okay? What about others, ma'am? I'm just making you. What about others? And Dr. Paul might be lucky enough. Dr. Smriti might be lucky, or even Manisha ma'am might be. But one or two. What about the rest of other people? That is why. That is why it is important that we should start thinking about our savings and investment right from the month we start earning. And the Smriti ma'am, the chart which we have just prepared, first column, second column, and third column. It is called, what it is called? It is called financial plan. My purpose of mentioning Dr. Paul's name for Amitabh Bachchan show was not to feel her happy. Only thing just to make her aware that she will need crores of rupees in her life. And that is possible only through your sustained savings and investment. And the chart which we have just prepared, that is Smriti ma'am, it is called financial plan. And Manisha ma'am, I am of the firm opinion that every family must have their financial plan. And it is not a rocket science, very simple thing. Sit with your family member, discuss everything about your major milestone in your life, then putting the year, then putting the money. Once your financial plan is ready, Manisha ma'am, now picture of your financial requirement is clear. What money you will need at what time, that is broadly clear to now. That is why I attach maximum importance to the financial plan, and I will request all of you, please do consider developing a financial plan of yours, because that will be give you a clear and distinct goal in your life, what money you will need at what time and for what purpose. So please do develop a financial plan. One more thing about investment I want to tell here is rule of compounding. And Smriti ma'am, rule of compounding you might not be aware. Rule of compounding is eighth wonder of the world. It is eighth wonder. We normally don't attach such importance to the rule of compounding, but otherwise it is the eighth wonder of the world. And what is rule of compounding in investment, Dr. Paul? Simply speaking, Dr. Paul has made a commitment with herself that whenever she will get some return on her investment, maybe 5,000, maybe 50,000, maybe 50 lakhs. Whenever she will get return or income on her investment, she will never use that return or income for her personal consumption, for her celebration, or for family affairs. What she will simply do continuously, regularly, whenever she gets some income or return on investment, she will simply club that return or income with the regular investment she is making and reinvest it. You have to reinvest your return on your investment regularly for 15, 20 years without fail. And this commitment you have to make it. Because if you do it, Dr. Manisha, a magic will happen in your life after 15, 20 years. You can't even think of what will be the multiplication of your money within a span of 15, 20 years. But it will be happening, Manisha ma'am, not today, not tomorrow. It will take time. It will take minimum 15 to 20 years. That too, when you strictly follow rule of compounding in your investment. So please do follow rule of compounding in your investment. That is a must for your prosperity. Because after 15, 20 years, you will be happily surprised that your return or income portion on investment has become so big, which you can't even imagine today. But that will be happening not today. It will be happening not tomorrow. It will be happening after 15, 20 years. So please religiously follow rule of compounding in your investment. Now, lastly, 10, 15 minutes, we will discuss about what are the products available in the market for middle class, salary class person. And the first category of products, because that is equally important, the first category, Dr. Smriti, the first category of investment products available for all of us is governmental small saving scheme. Government of India has got some small saving scheme for middle class, salary class person. And I personally feel that you must invest some of your money into governmental small saving schemes. And one and foremost Government of India scheme, Manisha ma'am, is Public Provident Fund Account, PPF. I don't know whether Manisha ma'am has opened an account in Public Provident Fund account or not. But if she has not done it, Manisha ma'am, you have not done something right. You have missed something. And Smriti ma'am, also I tell you and all other your faculty members, those who are young, please do immediately open a Public Provident Fund account, PPF account. It can be opened in any of the bank branches, and major and big post offices. Public Provident Fund account is a very unique scheme of the Government of India. The scheme is for 15 years, Manisha ma'am. And I will request Manisha ma'am, you should open PPF account not only in your name, but also open another account in your husband's name or even your children's name even. You can have multiple PPF account in the family. The minimum amount you should deposit in the PPF account, Manisha ma'am, is 500 rupees a year. Every year you have to minimum deposit is 500 rupees. and maximum limit is 1.50 lakhs. And I'm aware Dr. Paul has already owned the PPF account. Am I right, Dr. Paul?
No, sir.
Please do it. I have told you very clearly. Those who don't have PPF account, those who are already earning and those who are young like you must open your PPF account in the next 1 month. It's a very good scheme of the government of India. And it is basically triple E scheme, exempt, exempt, exempt. No tax at all at any level. Minimum amount is 500 rupees a year, maximum amount is 1.50 lakhs a year. And this scheme is for 15 years, Smriti ma'am, but you can extend this scheme by another period of 5 years, then 5 years, and also then 5 years. Because you can extend, so first it for 15 years, then you can extend it. And you should open not only your account, Dr. Paul, you should open account in the name of your husband, if you are married, and even for your kids. It is a very good scheme of the government of India, and even today government of India is giving you 7.10% interest every year, which is compounding every year. It will be included in the principal, and next year you will get interest on interest, including your principal. So please do open a PPF account. Second scheme is National Savings Certificate. I don't have time for I'm just mentioning the name. You please note it down if somebody wants to interested. Then go deeper into the Google and website, get the details. National Savings Certificate. Then third one is Kisan Vikas Patra. Very good scheme of the government of India. And third one is RBI also keep issuing bonds and bonds to the public. Taxable bond and tax-free bond. And even today the RBI taxable bond rate of interest is 7.15%, which is not a bad return. So after RBI, government of India also keep issuing security to the public, getting loan from the public. And so, Smriti ma'am, recently RBI has started a new website for government security that is called RBI Retail Direct. RBI Retail Direct. Very simple. You can go visit the website, register yourself, and then you start investing a small amount in government securities regularly. After that, Government of India, big undertakings or institutions also keep issuing bonds. Recently, you might have heard, Smriti ma'am, National Highway Authority has issued bonds. It is still on. It will be on and till November, which will give you 7.80% interest every year, and the yield will be more than 8 years. And all these schemes, and one more thing is Bharat Bond 1 and Bharat Bond 2. Government of India undertakings have started this channel, Bharat Bond 1 and Bharat Bond. All these schemes are under the umbrella of governmental small saving scheme. And Dr. Paul, the beauty of these schemes are there is no risk at all. No risk at all. Whatever government promises you, government will give you. When your scheme matures, whatever maturity amount is there, that will be given to you without any doubt. So return might be reasonable in governmental scheme, but Manisha ma'am, it is without any risk. That is the most important factor here. And I personally feel a normal middle class, family class person should invest not less than 15 to 20% of their total investment in governmental small savings. So please do think of these schemes and start investing regularly. After that, all products I am mentioning now have got risk. Please mind it. Except some one scheme which I will be mentioning, and when Manisha ma'am and Dr. Paul and Smriti ma'am all will smile like anything, I can guarantee you, when I will discuss that scheme. But before that, what I want to mention here is, most apart from government of India schemes, every other investment product have got risk. Some have got high risk, some have got lesser risk. But before that, I want to tell you, please do develop a basket of investment. Don't put all your money in one scheme. Try to spread your wings. Try to put your money into different schemes. In some schemes where the risk is high, but the reward is also high. Some scheme where the risk is moderate, but the reward is moderate. And some in governmental scheme when there is no risk. So please try to develop a basket of investment that will take care of your risk as well as your return. So the second product available is property or real estate where you can invest. And I don't know, I'm not an expert on property in real estate, but it has got risk. How much you will get returned when you sell the property after making investment, not sure. And again, in property, Smriti ma'am, you will need huge money to invest. That is also a minus point in property. But again, if you wish to invest, you invest. I don't have any prescription about the quantum of money you should invest in property. All this. Then third thing is where you can invest. And I know I am talking about some product where Manisha ma'am will smile, Dr. Paul will also smile, Smriti ma'am will also, and all other female participants will smile. That is gold. And when I mention gold, our female participants have definitely a smile on their faces. That is very natural. In a middle class family, and particularly female the members of the family, they always think of investing and getting gold as much as they can. That is very natural. But historically, Manisha ma'am, we have been investing in gold through uh, jewelry and biscuits. Am I right, Smriti ma'am? Historically, we have been investing in jewelry and biscuits. But now time has changed. And in jewelry, when you invest, Manisha ma'am, normally we don't sell our jewelry. Normally. We hardly any time sell them because it is a dead investment sometimes. It is called dead investment. You purchase jewelry and you keep it at home. And when you keep it at home, Manisha ma'am, you will not have funds found it because a thief might come and take away that jewelry. Or if you put that jewelry into a locker, you will have to pay annual maintenance charges of locker. That is also a costly affair. But now government has come out with a unique scheme for gold. And Manisha, when you please note it down and you talk this, you get the details about this scheme. Very noble scheme of the government of India with regard to gold. That is called sovereign gold bond scheme. SOVEREIGN. Sovereign gold bond scheme. Very good scheme of the government of India. In this scheme, government of India is inviting you to invest. Minimum amount you can invest in this scheme, Smriti ma'am, is 1 gram gold price, which government decides as per prevailing price of the gold. And maximum investment, Manisha ma'am, you can do in this scheme is 4 kg gold. 4 kg gold price you can invest in this scheme. The rate in this scheme of the gold is decided per tranche, every tranche by the government of India, which is broadly the prevailing rate of price of the gold. And government of India gives you two benefits under this scheme, Manisha ma'am. First is you will get 2.5% interest on your investment every year. Suppose, Smriti ma'am, you invest 1 lakh rupees, you will get to 2,500 rupees every year as interest. This is the first benefit. Second benefit is the scheme is for 8 years. The scheme is for 8 years. And suppose today, Manisha ma'am, you make the investment at the gold price of 50,000 rupees 10 gram. Suppose today. After 8 years, the gold price is 80,000 10 gram. Then, Manisha ma'am, you will get 80,000. Not 50,000, but 80,000. Whatever the prevailing price at that time will be given to you. And no physical gold will be given to you. Only a sovereign gold is a foreign certificate from the government of India that we we have kept this much of gold for you. So basically, it is physical gold you will not be required to have. But it is a sovereign government of India scheme, so there is no risk at all. Whatever government is promising you, that suppose after 8 years, Smriti ma'am, you need gold, you get the 80,000, you go to the market and purchase the gold. Simple, simple, simple. And if you remain in the scheme even for 8 years, which is the maximum period of the scheme, Manisha ma'am, that tax liability will also be literally zero because of indexation benefit and capital gain, all this. These are technical things I don't want to go into detail, but tax liability will literally be zero. So sovereign gold bond is a very good scheme of the government of India for keeping gold, because you will not be keeping gold at home. When you keep it, Smriti ma'am, you get nothing, not a single penny you get. But here, government of India is giving you 2.5% guaranteed interest plus appreciation interest. So please think of applying and in this applying investment in this system. After that, and lastly, where you can invest in security market. I don't have time, so next time when Dr. Paul and Dr. Manisha will give you time, we will discuss in detail about the security market, including technical aspect of the security market, how it functions. But for today, very briefly, I want to tell something in 2-3 minutes only. Security market is a risky proposition. Very honestly, I want to tell you. Those who don't have knowledge of the market must not invest into security market. This is my personal opinion. Normally, people invest in the security market on the advice of others, which they should never do. Unless and until you have knowledge, please avoid investing in security market, at least directly. But there is an indirect way of investing in security market, Smriti ma'am, that is called mutual funds. Mutual fund is an indirect way of investing into security market. You are not directly investing. You are giving your money, your savings to the experts to invest into the as per guidelines of the scheme. Why you are giving them? Because you don't have any, you don't have knowledge of the market, and you don't have time to look after your investments. So mutual fund is a proposition where you are giving your money to the expert, but the proposition is very clear, Smriti ma'am, that invest my money as per guidelines of the scheme, generate maximum return for me and give back to me. This is simple proposition. It is not a social service. It is not a social service at all, Manisha ma'am. I am giving my money with the expectation that I should get maximum return on it. So mutual fund is a proposition for those who don't have knowledge of the market, but still wish to enjoy the benefit of security market. In mutual fund, there are three categories of major three categories of investment. One is equity market, equity fund. Second one is debt fund, and third one is hybrid fund. Equity fund simply means your money will be invested, Manisha ma'am, into the equity share of the corporates. It is a highly risky proposition, because we all know share price of the shares always keep go up and down. So the risk is higher, but so is the reward. And Smriti ma'am, you must be aware of the basic rule of economics: more risk, more reward. But it doesn't mean that guaranteed reward. You increase your probability of getting higher return if you take high. So in equity fund, the risk is higher, but the reward can also be higher. So equity fund is suitable, Manisha ma'am, for those who are young, those who can invest for minimum 5, 10, 15 years, those who can take high risk. Equity fund is there. Second category, debt fund. Debt fund simply means your money will be given as a loan to the corporates. It will not be invested into the equity share of any corporate. Please mind it. It will be invested into it will be given as a loan to the corporates. And when a loan is given, the risk is lesser, so is the return. So those who don't want to take high risk and are satisfied with a reasonable return, that fund is a proposition for them. And third category is hybrid fund. Hybrid fund simply means some of your money will go to the equity fund and some of your money will go to the debt fund. So you are getting the benefit of both, taking some risk, but at the same time you are protecting yourself from high risk. So hybrid fund is the third category. But the magic of the mutual fund, Smriti ma'am and Dr. Paul, for all of you is SIP, Systematic Investment Plan. Last 5 minutes only, Dr. Paul. Please open your video and Dr. Smriti as well. Last 5 minutes only. SIP is a magic for middle class, salary class person. And SIP is nothing, Dr. Paul, but simply regularly investing a small amount for longer period. And it is just like a recurring account, Dr. Smriti, you might have opened with a bank. Recurring account means simply every month you are investing something. The same thing goes with the SIP. Every month you are investing some money, maybe in equity fund, maybe in debt fund, maybe in hybrid. In any of the fund category, you can start SIP. And SIP is more suitable for the middle class, salary class person, Smriti ma'am, because we get regular income every month. That is why every month we can invest something. And minimum amount you can start SIP is 500 only. Maximum there is no limit, Manisha ma'am. You can start a SIP of 5 lakhs even every month. And SIP can be monthly, can be fortnightly, can be weekly even. So you can start an SIP, and SIP is a magic for middle class, salary class person. I just want to give you one factual example, but I will not name the scheme or I will not name the mutual fund company, which is the AMC, because that will be unfair market on my part or their market. But facts I am sharing with all of you. In 1995, I don't know whether Professor Cyril is there or not. I will take the name of Professor Cyril in that example now. In 1995, Professor Cyril, who was very young at that time, he is still very young, but he was very young at that time. He started an SIP of 10,000 rupees in that equity scheme in 1995. Means every month he is investing 10,000 rupees in that equity fund right from 1995 to 2022. Every month he is investing 10,000 rupees a month. And he is a rare person in the sense that normally, Manisha ma'am, what happens when market goes up, lot of people come and start investing through SIP and other form. But when market goes down, they simply backtrack. This, or Baba, I will lose some money or I have lost some money. They just get a fear sight and they withdraw their money. That's the blunder they do. Because Smriti ma'am, please mind it. Market will always go up and down. This is the basic character of the market, Manisha ma'am. You should appreciate. Market will always go up. Today market might be up. Tomorrow market will be down. It will keep happening every year. Some years might be good. Some years might be bad. Some months might be good. Some months might be bad. So going up and down is the basic character of the market. But Professor Cyril never looked at the movement of the market. He continued investing 10,000 rupees every month, Manisha ma'am, right from 1995 to 2020. Would you like to know the corpus he had developed by now? Smriti ma'am, Mrs. Professor Cyril has got a corpus of 9.50 crore. He has developed a corpus of 9.50. But again, 2-3 things you should understand. Continuous investing without looking at the moment of the market. Continuous. Longer period. Not 5 years, not 10 years, 15, 20, 25 years. There will be huge corpus you will develop it. So please do understand the importance of SIP. Start SIP right now. A minimum SIP period is 500, amount is 500 rupees. And Dr. Manisha, I will request even your students, start an SIP of 500 rupees in a good equity fund, large cap fund or index fund out of their pocket money. Even out of their pocket money, and those who are already earning like Manisha ma'am, Smriti ma'am and Dr. Paul, Paul ma'am, you should start as much SIP as, because I know a lot of my friends who have not one SIP but multiple SIP, and all SIP, Smriti ma'am, are target oriented. One SIP for going on vacation after 5 years, one SIP for purchase of house, third SIP for higher education of children happening after 25 years, fourth SIP for marriage of the children, and last SIP for retirement plan. So you can have multiple SIP, and now you can increase your SIP amount every year. Automatic, that facility is also there. So SIP is a magic for middle class, salary class person. Please do start SIP when you are young and continue it for minimum 15, 20 years. Magic will be happening in your life. You will have huge amount. And lastly, of course, mutual fund is a very big topic. I can't I can't justify it in a shorter period. Next time, if you are interested, Manisha ma'am, we will have a detailed discussion on the mutual fund. That will be minimum of 1.5 hours or so. Lastly, I want to request one thing to Manisha ma'am, to you and I don't know whether principal sir is there or not. RP Singh sir, I want to request you and all faculty members. There is a meanness in our country, and Assam is also one of the focal point of that meanness. Smriti ma'am, that is called chit fund committee and Ponzi schemes. People do come with the promise of doubling your money in 3 or 4, 5 years, giving you 15% return, giving you this or that return. They are all fraud. I am using very harsh word. They are all fraud, Manisha ma'am. They will never make their promise good because there is no business model. They will simply go collect your money and vanish one day. So please never invest your hard-earned money in Ponzi scheme, chit fund and committee. And in Assam too, lakhs of people have lost crores of rupees. I know, Smriti ma'am, you will not invest. You are intellectual, you are literate person. Who are investing mostly, Manisha ma'am? Not you, not literate. Mostly those segment of the society who are not so literate. Your peon, your driver, your milk vendor, your rickshawala, your electrician, your plumber. They are investing their hard-earned money in those fraud schemes. So Manisha ma'am, I will request one thing to you, and not you, to all faculty members, including your principal sir. Start a campaign through your students across your area. Try to educate as much people as you can that they should never invest their hard money in Ponzi scheme, chit fund and committee. If they don't have anything, no problem. If they don't have any knowledge at all, no problem. They should simply put their money into post office and banks. At least their money will be safe. So please, this is your social responsibility, Manisha ma'am. Take it forward. And in the last, I am again thankful to all of you for giving me opportunity and to be with you. And I will be more than happy, Dr. Paul, to come to your college physically as well at the first opportunity. Thank you very much.
Thank you, Mr. Suryakanta Sharma sir, for your motivational, informative, and enlightening speech that comes out of your profound knowledge, expertise, and wisdom due to your long real life professional experience. So, in this session, we have learned a lot regarding various schemes like life insurance cover, which like umbrella health insurance cover, then adequate life insurance, adequate health insurance, then the difference between money accumulator, money creator, and the simple strategy of investment is just think, understand, and invest. And we should start investing at a very lower age, and younger people can take more risk as compared to aged. And we have come to know about public provident fund account. The minimum investment is rupees 500 and maximum 1.5 lakh, and which is totally tax exempted account. And we should invest in PPF before 5th of any month to get the interest of that month. Then NSC, KVP, different types of RBI tax-free and taxable bonds, then governmental securities, then Shukanya Samriddhi Yojana, then Bharat Band 1, Bharat Band 2, equity fund, debt fund, and equity fund is high risk and debt fund low risk, then hybrid fund, then we come to know about SIP. So everyone should have SIP or should invest in SIP. So now I would like to invite our most beloved colleague Caroline ma'am to carry on the interaction session. Caroline, are you there?
Hello.
Yeah, it is over to you.
Okay. Good evening, one and all. Thank you, Dr. Jogomaya Paul, our convener, for giving me this time for the interaction section. I'm not here to propose a vote of thanks, but from my personal side, I would like to give a big thank you to our honorable guest speaker, Mr. Suryakant Sarma, for his invaluable knowledge, which she shared to us, which is beyond price. And I'm sure after having listened to our great speaker, everyone participating in this webinar must have accumulated ample of knowledge about the strategic and judicious use of our income and a well-planned journey to financial securities and freedom. Thank you so much, sir. This learning session has been so insightful and satisfactory so far. Taking this opportunity, some participants must be very inquisitive enough to clarify their big why, big how, and also their doubts. So I would like to request the participants, if you have any queries, you can put your questions, you can put forward your questions in the chat box. You can start.
I would be more than happy if Professor Cyril sir unmute himself and give his observation about the session, about my session. Professor Cyril sir. Yes, sir. If you unmute yourself, because he is such a senior person, I would be more than happy to get his observation. Mr. Sabdar, please help him unmuting. Mr. Sabdar.
Hello, sir. Yes, yes.
Please help Professor Cyril to unmute.
Sir, please, sir. So there is some technical issue from Caroline S side, sir.
Okay. Now, if anybody has any participant has any question, just raise their hand. We will unmute him or her.
Participants can directly ask question to our speaker.
Just raise their hand. We will answer their questions. Any
Hello?
question from any participants?
Hello.
Mr. Sabjar, please unmute him. He is trying to speak.
Yes. Please continue, please.
No, Professor, he not able to unmute.
Sir, from our side, he is the co-host of that, sir.
Just tell him to unmute himself.
Please unmute your idea option, sir, please.
I think he's trying to unmute, but he's not able to.
Yes, sir, there is some technical issue or network issue from their side, sir.
Caroline? Caroline?
Yes.
Okay.
Are you
Am I
there?
audible? Hello?
Okay, yeah, you are audible.
Okay. So, participants, if you have any queries, you can put forward your questions directly, or you can drop your questions in the chat box.
I think no questions are there from the participants' side.
No problem. Then Dr. Paul will.
Then, yeah. Now,
Sir,
according to
Sir, I have one question.
Yeah. Please. Yeah.
Sir,
Yeah.
please say something about the investment in stock market. Stock market, sir.
Shruti ma'am, I had told you that stock market is a technical subject, firstly. Secondly, if you give me time, next time we will discuss exclusive security market for 2 hours. But
Okay,
as far as investment in security market is concerned, I again repeat, it is a riskier proposition. Those who don't have knowledge of the security market must not invest directly into security market. In my personal opinion. But mutual fund is the indirect way of investing into security market. Because money will be invested by the experts on your behalf. Why it is more advantageous is that they have got knowledge, they have got experience, they have got lot of in-depth study and research with regard to security market. So their decisions are likely to be likely, again not guaranteed, because nobody is master in security market. But their decisions are likely to be more advantageous for the retail investor. That is why for middle class person who don't have any knowledge of the market, should better go into the indirect
mutual fund.
Through mutual.
Thank you, sir.
But next time we will discuss in detail about the security market.
Definitely,
Then all
sir.
technically we will discuss. Even that will be beneficial to your students also. What about the security market, IPOs, exchanges, SEBI role, everything we will discuss. Yes, Mr. Rao.
Thank you so much, sir.
Yeah, Mr. Dharamraj, sir.
Dharmaraj, yeah.
Sir, very good evening, sir.
Good evening, sir.
Sir, I have one question is, what way to help to RBI retail director, sir?
Hello, sir.
What way to support RBI retail director through the investor?
Yeah. Basically, it is an investment in government securities, sir. Government of India earlier, it was difficult for middle class, salary class person to invest in government security. But to facilitate inflow of middle class, salary class savings into government security, RBI in consultation with Government of India had started a website which is called RBI Retail Direct. You go to the website, register yourself, then after registering, you can start investing a small amount in government security, which was not earlier so easy.
Okay, sir, I have one question.
Yeah, please go ahead.
Hello?
Yeah.
Okay.
Thank you, Professor. Thank
Sir,
you.
Yeah.
okay. Sir, what is the minimum rate of return from SIP? Minimum rate of return
or maximum, there is no limit.
monthly.
That's why I'm telling you.
Okay.
There is no minimum or maximum return. It all depends upon the conditions of the market and how much you have been in the SIP. Because the only crux I again want to repeat, Dr. Paul, is start an SIP and continue with the SIP for a longer period. And historically speaking, no future guarantee. Historically speaking, a good number of equity funds have given an average return of 15% annual, which is not a bad return. But again, historically speaking only, no guarantee for future.
Okay, sir, I have one more question.
Yeah.
Say like if I invest around 20,000 rupees in Public Provident Fund, PPF, say for about 15 years, then after 15 years, what will be the minimum return that I can expect as a regular investor?
20,000 you are speaking every month or every year?
Every month.
Every month. So it will be,
Yes.
what it will be, multiply by 12, what it will be? You can't invest 20,000 per month. The maximum limit in PPF is 1.50 lakhs only annually.
Okay, annually. Okay.
Maximum you can invest is 1.50 lakhs. So if you invest more than 1.50 lakhs, you will earn no interest at all. So why we will invest it? So maximum limit is 1.50 lakhs. And for 15 years, it will be 18 lakhs your principal investment. And broadly speaking, you will not get not less than 35 lakhs.
Okay.
Broadly, depending upon the present rate of interest and a lot of other factors. But it is a safe investment. Please do understand, there is no risk at all. And there is no tax liability at all.
Okay. Okay. Thank you, sir.
Any other question from any participant? Manisha ma'am would like to speak something on the session.
Hello.
Yeah.
Yes, sir. It was a very interactive session between the participants, that is us and you. And I learned a lot about the SIP, which I didn't have at first any idea about. And about Sukanya Samriddhi, as I have a daughter, I would definitely like to invest some for her future.
Definitely, ma'am,
education.
without fail, without fail.
Yes, sir. Yes, sir.
So now I would like to invite Manisha Singha, one of my beloved colleague, to deliver the vote of thanks. So Manisha, you can continue.
Thank you, ma'am. Good evening, everyone. I, Mrs. Manisha Singha, Assistant Professor of Sapatgram College, would like to convey the vote of thanks on behalf of Sapatgram College, Department of Economics. First of all, I would like to thank our principal, Dr. Rajendra Prasad Singh, for giving us this opportunity to organize this event. Next, I would like to thank our HOD, Ma'am Smriti Rekha Burman, for all the encouragement and support that was needed for organizing this event. And I will like to thank our convener, Dr. Jogomaya Pal ma'am, assistant professor of our department, who was very enthusiastic, and she organized the whole event with a very hard zeal. And next, definitely, sir, I would like to convey my heartfelt gratitude to you, sir, Mr. Suryakanta Sarma, our key speaker for today, who is a senior consultant in AMFI and who has also been serving as a former DGM in the SABI. Indeed, sir, it has been a very, very learning experience for me, and for my personally, I have been very encouraged to invest in my daughter's name through all this, and also I would like to invest in the SIPs. And thank you, sir, for your this commendable knowledge and sharing your time with us. Then I would like to put my thanks for all the colleagues and all the students of our college who have been also supporting us in organizing this event. And last but not the least, I would convey my thanks to all the participants who made this event a grand success. Thank you to all and all.
I'm also thankful to our principal, Dr. R.P. Singh, particularly Dr. Jogmaya Paul ma'am, who has taken this initiative in your college, and Manisha ma'am, Swati ma'am, and all faculty members and staff members, all participants, and of course, special thanks to Mr. Sabjar Ahmed for initiating this discussions with you and for taking this forward. Mr. Sabjar, thank you very much. And in future also, Dr. Paul, we will keep doing such programs with your active support.
Definitely, sir.
Thank you. God bless you all. Thank you very much.
Sir,
Thank you, sir.
1 second, sir. So finally, I would like to thank